We looked at merger and acquisitions. We have seen that there are multiple reasons for which managers engage in merger and acquisition transactions. We looked at some of them, and then we have identified which of those are good reasons for merger and acquisitions and which of those are not so good reasons for merger and acquisition transactions. Okay, so after the strategy bit, so strategy is probably the most important part, right? So once you have identified the strategy or the reason or rationale for merger and acquisition, the next step is to identify the target firm, right? So the target firm should be in line, the choice of target firm should be in line with your strategy, right? Why you are engaging in the merger and acquisition activity in the first place. So we know that you can acquire other firm for a number of reasons. So if the motive, for example, is for operating synergies, right? The typical operating synergies basically are economies of scale, right? So which means that you reduce your average production cost, right? Which results in cost savings. And the other main reason is to expand. So your growth rates tend to be higher. If you want to achieve higher growth rates, right, then acquisition is one way in which you can increase your revenues or presence in multiple jurisdictions and multiple areas. So it would result in higher growth rates. Then there are financial synergies. We talked about these as well, right? So tax saving is one reason, one source of financial synergy. Then we have debt capacity, ability to borrow more, right? So if you combine resources, you have greater number of assets, and then with larger asset base, it might allow you to borrow more, right? And also it can reduce your cost of capital, right? So reduction in your cost of capital is another source of financial, is another source of synergy, right? Which is basically due to finances. So we call it financial synergy. And then we have cash slack, so has greater projects but no funds. So if a company has a lot of investment opportunities, good investment opportunities, but if the company does not have enough funds, so it can acquire a firm that has a lot of cash, for example, right? And then the combined firm will have cash, and then they can use that cash to invest in those other positive NPV projects. Diversification, as we have discussed in a lot of detail, is one of the reasons why managers engage in merger and acquisition activity, but in reality that's not a good reason because individual investors can do it better. Control, so when a firm is not optimally managed, then you can increase value by removing the poor performing management. And then undervaluation, reasons, which is essentially identifying an undervalued firm and then acquiring it. So which is basically a positive NPV investment, right? Because you're paying less for a company that is valued more. Okay, so let's look at the structure. So this is the other important bit in the acquisition process. So in terms of structure, you have to decide how you're going to pay for the target firm. There are a number of ways in which you can pay for the target firm. So you can decide on the method of payment. So for example, stock or cash. So you can acquire the target firm's shares by paying them cash, right? So these are called cash acquisitions, right? So if on the left-hand side we have the sellers, shareholders, and then we have this target company, right? And then on the right, slightly on the right, we have the acquirer firm. So acquirer firm, if you're paying by cash, the acquirer firm needs to have sufficient cash. So acquirer firm, gives cash to target firm's shareholders, and target firm shareholders give their shares to the acquirer. Right? So acquirer firms get ownership stake in the target firm by acquiring the shares from sellers or target shareholders. Okay, acquirer firm pays cash, and in exchange for cash, they get shares of the target firm. Okay, so this is stock for cash. So acquirer firm is paying cash in exchange for shares or stock of the target firm. Yep. Okay, so this is how it would look like after the transaction. So acquirer firm now owns the target firm because target firm's shares are now acquired by the acquiring firm, right? So target firm's shareholders have sold out their short shares. So shareholders of the target firm cashed out, right? And who gets the ownership now? The acquirer firm, because acquirer firm bought the shares of the target firm. So you can see in this case, acquirer now directly controls the target firm. The other way to pay is stock for stock. So in this case, in exchange for target firm's shares, you're not paying them cash, but you're paying them with your own company's shares, right? So you're exchanging your firm's shares in exchange for target firm shares. Okay. So how it would look like before the transaction? So we have a target company, and there are shareholders of the target company. We have acquirer firm and shareholders of the acquirer firm, right? But what is happening in this transaction? The acquiring company gives its shares in exchange for shares of the target. So now these target firm shareholders own shares of the acquirer, right? Okay. So these target shareholders, target firm shareholders, become new shareholders of the acquiring firm, right? Because now they get shares of the acquiring firm. So after the transaction, this is how it would look like. So selling share, so the acquiring company now owns the target company. How do they own the target company? Because target companies shareholders exchange their shares with they exchange their shares. So now they own acquirer firm shares, right? So they sold out their original company shares in exchange for shares of the acquirer firm. So now we will have two set of investors in the acquiring firm. The all original shareholders of the acquirer plus the target firm shareholders who have exchanged their own shares to get the shares of the acquirer firm. Okay, so we'll have two set of investors now. Old shareholders of the company and then new shareholders. And who are these new shareholders? Target firm shareholders who have sold their stake in the target in exchange for a proportionate stake in the new firm that has assets of both the acquirer as well as the target. So essentially the new company is a combination of these two, right? Because acquirer now controls the target. Okay, so their assets are combined. Okay, so in this case, you can see you're exchanging one stock with another one, right? Target firms are giving away stock of the target in exchange for the stock of the acquirer. So in this case, an exchange ratio has to be established, right? With what proportion you're going to exchange the shares. So the formula for this is actually very, very simple, right? So you're swapping or exchanging shares of the target in exchange with shares of the acquirer. So how to establish this exchange ratio? So you look at the offer price, what's being offered to target shareholders, right? So offer price to target shareholders, which is typically higher than their market value because of premium, right? Okay. So offer price for target shares, and you divide it by the acquirer's share price, and that establishes the exchange ratio. So here we have an example. So our target firm shares trades at a pre-acquisition price of 20.8, and there are 10,000 outstanding shares. The acquirer is trading at $13 per share and offers the target a 25% premium. So what is the exchange ratio? So offer price, what's the offer price? The current price is 20.8, but you're not offering 20.8, right? You're offering 25% premium, right? So if you add 25% premium to it, that becomes 26. So your offer price is 26, and you divide it by current share price of the acquirer, which is $13. So 26 by 13 gives you a 2-for-1 ratio. So which means the target firm shareholders will get 2 shares of the acquirer in exchange for 1 share of the target. Okay, that's 2-for-1. So you'll get 2 shares of the acquirer firm by giving away 1 share of the target firm. So the acquirer will have to release 2 shares for each share of the target firm. Right. So if you, I will ask this to you as future managers. So if you are the manager of a company, which acquisition method will you choose? Would you like to pay by cash or would you like to pay by stock? So those of you who would like to pay by cash, no one? Those who would pay by stock? Okay. All right. So some of you would like to pay by stock. Okay, so let's see the conditions, that will determine what should be the appropriate way to pay. So stock for cash. So this is suitable when the acquirer has a lot of cash, right? That makes sense. When the company has a lot of cash to spend, then if you already have a lot of cash, you do not need to raise it. So you can use that cash to buy another firm. So you can pay by cash if you already have a lot of cash. But more importantly, you would like to pay by cash when you believe that your own shares are undervalued. If your own shares are undervalued, right, then you would prefer to pay by cash. Why? Because if you believe your shares are undervalued, then in exchange you'll be paying more, right? Because the actual value is higher. So the exchange ratio will be higher, right? So when you believe your own shares, when acquired shares are undervalued, they would prefer to pay by cash. And the vice versa is true. When you believe that your shares are overvalued, right? So let's say your shares are worth 15 pounds, worth 10 pounds. But currently, let's say they are trading at 15 pounds, right? So the exchange ratio will be determined by 15 and not by 10, right? Okay. So in this case, you will pay less when you are trading above your fair market value. So then you would pay by stock. So the benefit for acquirer is that the cost of acquisition is fixed. That's one of the advantages of paying by cash, because if you're paying by cash, you predetermine what price you're going to pay. But if, for example, you're paying by stock, right, and the price of stock can go up and down, right? So your total cost is not confirmed until the transaction takes place, right? In cash transactions, the price is fixed. The drawbacks is uh, that if you are paying by cash, you can end up having some cash problems because you have spent a lot of cash buying the shares of the company, right? So if you have spent a lot of cash, then you can have cash strain or future problems with your cash management. And if you do pay by cash, from a target point of view, they realize the capital gain, right? And then they would have to pay capital gains tax, right? So the reverses, the opposite of these are applicable when you pay by stock. So as I said, you will pay by stock when you believe your shares are either correctly valued or these are overvalued, right? Then you'll pay by stock. Okay, so the benefit for acquirer, there is no cash strain, right? Because you're not paying by cash, you're paying by equity, right? Benefit for target, they postpone their liability to pay capital gains tax, right? Because they're not realizing the capital gain. They're just exchanging shares, right? So they haven't realized the gain. If they haven't realized the gain, they don't have to pay the capital gains tax. And shareholders, the other key advantage for the target firm is that unlike a cash offer, once they cash out, they have no investment left in any of the company. But if they exchange shares with exchange shares and acquire shares of the target, then they have some investment in the target, both in the acquirer and target firm, because now the acquirer firm controls the target firm as well. So they still have some investment. The drawbacks, acquirer, there is a risk of overpaying if they pay by stock, right? And of course, there's dilution, which I explained earlier as well, right? So if you're paying by stock, now you are including other shareholders, right? You're bringing in new shareholders, which were the shareholders of the target firm, right? Because you're giving them your shares, so now they become part owner of your company as well. So it results in dilution. So drawback from a target point of view, the value that they will gain is uncertain. Because if, for example, the new firms acquire firms shares drop in value, right, then they will have to bear the loss as well, right? Because they own those shares. So the value of the shares is uncertain, and as a result, their gain in the transaction is uncertain as well. Okay, so the last thing in the acquisition strategy is the follow-up. So do companies achieve their intended objectives from merger and acquisition transactions? So this is data from McKinsey and Co. So who have looked at 115 merger and acquisitions in the UK and the US in the 1990s, and then we have data from KPMG, who studied 750 merger and acquisition transactions in India between 2005 and 2015, right? And if you look at the percentages, they are fairly similar, right? Even though they are in different jurisdictions, but the distribution of results is very, very similar. So the red shows when returns are lower than cost of capital. When returns are lower than cost of capital, what does it mean? Your cost of capital is higher, which means your required return is higher, right? And your actual return is lower. Okay. So in 60% of the cases, firms after merger achieve lower than expected returns, right? 60% of the firms achieve lower than expected returns, right? And then we have 17% of firms where cost of capital is exactly equal to the return, right? So in both of these cases, you can combine both of these, right? Because in these cases, there is actually no value generated because the returns are either equal to or lower than your required returns, right? Okay. So 16 plus 17 is how much? 77%. So which means in 77% of the cases, your expected returns, your actual returns are either equal or lower than your required returns, which means there is no value generated, right? Okay, or in fact, in 60% of the cases, it's less. Actual returns are lower than expected, which means negative returns, right? Okay, so and only in 23% of the cases, your returns are higher than expected. So which means only 23% of transactions result in synergies, add value, and remaining 77% do not add any value. And most of them destroy value, right? It's very similar results based on data from India as well, right? Okay. So I've given you this data. So what do you think? Merger and acquisitions on average add value or destroy value? They destroy value, right? If they destroy value, why do we engage in merger and acquisitions? Right? We should not. Only a small fraction of merger and acquisitions are successful. A lot of those merger and acquisitions destroy value. Okay. All right. So I want you to quickly log in again. This time I want all of you to log in, right? And quickly. I mean, it should be quite straightforward because you have already logged in once, right? You're logged in. Okay. All right. So the first question is, cash offers are better for target shareholders when the acquirer is undervalued. So now you have to think about target shareholding, right? If you are target shareholders, which one would you prefer? Would you prefer cash or would you prefer shares of the target, shares of the acquirer, right? And the information is that acquirer is undervalued. So which one would you prefer, right? Shares or cash? Shares of the acquirer or cash? Okay, so almost everybody made their choice. So let's see what you guys think. Ready? Are you ready? So a lot of you, so you think cash offers are better, right? This is cash offers are better. Why cash offers are better? So 67% of you think cash would be better. This is actually not true, right? Why? Why cash is not better? because the acquirer is undervalued. If you get the acquirer's share, right, which means you'll get more shares given that it's undervalued. Right? Okay, so let's say the fair value of the acquirer is 10. Let's say target firm share price is 20, for example. Right? Target firm share price, for example, is 20. And so this is target, let's say. Target firm is 20, right? So, and acquirer price, fair price is, let's say, 10. But because it's undervalued, right? So it's currently trading at 5, for example. Right? That's what it means, right? Yep. So if it wasn't undervalued, what was your exchange ratio? 2 for 1. Right? Okay. But given that it's undervalued, what is the exchange ratio? 4 for 1. Right? So you should have actually received only 2 shares of the acquirer. But given that it's undervalued, you have acquired, you have gained a lot more shares. This is not going to stay at 5, right? This is going to correct to 10 at some point in time, right? So you would have preferred, you should have preferred stock because your exchange ratio in this case would be much higher, right? Okay, and the reason for that is that the acquirer firm is undervalued, right? If it was reversed, if acquirer firm was overvalued, then you would have preferred cash. Okay, good. All right. Okay, so next question. When merger synergies are uncertain, target shareholders would prefer cash offer or stock offer. So how come you drop out? Some of you drop out. So what does this mean? When merger synergies are uncertain, which means you're unsure what will be the value added as a result of merger, right? You're not sure whether merger or acquisition will add value or it will destroy value. If you're unsure, right? So you have to answer it from a target's point of view. So if a target shareholder, which one would you prefer? Cash payment or would you want the stock of the acquirer? Okay, good. So I'm going to close the poll. So let's see what you guys think. Good, very good. So a lot of you, most of you think that it should be cash offer, right? Because if the value is uncertain, right, then you would want the cash offer. Why would you want the cash offer? Because we don't know whether merger will add value or destroy value. If, for example, if merger adds value, then you would have been better off by getting the share of the target, share of the acquirer, because price would have gone up if it added value, right? But if it destroyed value and you had the share of the acquirer as well, so if it destroyed value, share price would have gone down. So you would have shared the loss as well, right? Okay, because when you're uncertain about the outcome of the merger, then you would prefer the cash payment, because by getting the cash payment, you lock in your return, right? You lock in the return that you will get as a target shareholder. So cash offer is the correct answer. Okay, good. So here we have the market value for company A is 200 million and company B is 50 million. Financial analysts estimate that if the two companies merge, the new company will be worth 275 million. If company A pays 65 million for company B, what is the value created as a result of the merger? So what is the value created as a result of the merger? Okay, you're taking too long to think about this. So by now you should have seen that I don't ask very tricky questions, right? I ask yes or no kind of questions, right? Which is simple. So this is also very simple if you just read the question carefully. Okay. All right. Okay, so almost like everybody has decided. So those of you who haven't decided, just make a choice right now. Okay, 3, 2, and 1. All right, so let's see what you guys think. Good, very good. Okay, so we see quite a distribution here. Okay, but most of you have actually got it right. So 42, more than 42% think it's 25 million. It is actually 25 million. Why? What is the value of A? So 200, right? Value of B. And what is the combined value of A and B? 275, right? Okay, so the value created is 25 million. Okay, it was just addition and subtraction, right? So the two firms individually add up to 250, right? But we know as a result of synergies, the combined value is 275. So 275 minus the sum of their individual values, which is 250. So there's an addition of 25 million, right? Okay, good. Okay. Right, last question. And then we'll look at the last part of this session. So it's the same problem, right? Same data, but the question here is what is the percentage change in price of company A and B on merger announcement respectively? So change in price of A and change in price of B. Guys, you're taking too long and we are running out of time. Okay, make your choices. You're done. Good, very good. All right. Okay. Good. So if you don't know, I would recommend you make a guess, right? Because I wouldn't know uh, who has guessed, right? All I see is the average results, right? Okay. So what do you think? Okay. All right. Very good. So I'm going to close the poll now. So last chance to make your select your options. Okay. All right. Ready? Ready to see the answers? Yep. Ready to see the answers? Okay. Okay. Oops. Very good. Okay. So the answer is 3. Option number 3. And most of you have got it right. Okay. So 1 to 3. What is the change in price of the acquirer? From 200, it goes up to 210, right? Okay, and for the target from 50, it goes up to 65, right? So let's do it for target, for example. Okay, so 65 over 50, or you can simplify it. You only look at the gain, which is the 15 part, right? They were valued at 50, but they got 65, so the gain is 15 divided by their value. This is equal to 30%, right? And you can do the same for the target, oh sorry, acquirer, and that comes up to 5%. So 5% gain for acquirer and 30% for the target. Good, very good. Okay, good. So this is the last part for today's session. So we'll look at some of the stated motives of merger and acquisitions. We have covered some of them. And then we'll look at some other motives of merger and acquisition. So we know that we should only engage in merger and acquisition transaction when there are synergies. When as a result of merger, there is a gain element, there is a synergy element to it. Okay, so the combined value of A and B will be greater by the amount of synergy, which is represented in this equation by gain part. And I've shown you the data earlier, right? We have seen that 77% of the transactions roughly fail. Okay, only 23% are successful. So why we still see a lot of bad mergers, right? Okay, so one of the reasons is that, so if you look at merger and acquisition transactions, in the example that we just looked at, right? The gain to target shareholders was how much? What percentage of the gain to target shareholders? $6. 30%. And what was the gain to acquirer? Only 5%, right? And I've told you earlier as well that when you make an offer to the target shareholders, you make it at a premium. And that premium typically is between 20 and 30%. So which means target shareholders will definitely benefit, right? Because they get more. Okay. So target shareholders gain as a result of merger and acquisition transactions. But what we are not sure about is the benefit to the acquiring firm shareholders. One of the reasons that acquiring firm shareholders do not gain from the merger and acquisition is because of something we call the winner's curse. What do we mean by winner's curse? That if you are in a bidding war, if you are bidding for something in merger and acquisition case, it's a target firm. If there are multiple firms bidding for the same target, then the winner tends to overpay, right? If the winner tends to overpay, that results in a loss to the acquirer, right? To the winner. Because they have in the bidding war, they end up overpaying for the target. So the other reason for merger and acquisitions is the increased market power. So which is the increased size of the firm, right, and gives you greater market control. One other reason that we looked at for merger and acquisition is that they can exploit economies of scales, which could be in marketing, it could be in manufacturing, it could be in administration, R&D, purchasing, financing, right? So you can achieve economies of scale uh, as a result of merger and acquisition transactions. There could be economies of scope, so you can increase your capabilities. You can increase the size and type of products that you offer. You can go in different jurisdictions, right? So merger and acquisitions allow you to benefit from economies of scope. A good example of economies of scope is the merger between Crofts, so the acquisition of Cadbury by Crofts. Entry to new markets and industries is another motive. So, for example, if there's a US firm that wants to uh, sell in, for example, Europe, right? So one way is that it establishes its presence in the EU and then start everything from zero and build everything up. The other way is that you acquire a firm in the EU, right? And then start serving EU customers more quickly. So by merger and acquisitions, you gain entry into new markets, you gain entry into new industries as well. So it's a quick way to buy know-how and and increase the critical size of the firm. There are tax advantages, right? So if you acquire a firm that is making losses, so you can offset it against the gains of your firm, and as a result save some tax. Increased ability to use, so something similar, increased ability to use tax shelters. So you can reduce risk, which is when you diversify, right? So diversification is the stated motive of merger and acquisition. Elimination and replacement of inefficient managers by a management team with superior abilities. So you can take control, remove inefficient management, and replace it with better managers. And then we looked at undervaluation of shares as one stated motive. We looked at this free cash flow argument. If you have a lot of cash flows, then you can use those cash flows to acquire other firms. But we know that surplus cash waiting to be spent rather than handing it back to shareholders, right? Because if you have surplus cash and you do not have good investment opportunities, then the best thing to do is to return that cash back to shareholders. But managers may not necessarily do that, right? If they use the cash, instead of returning the cash back to shareholders, they can buy other firms. And if they buy other firms, the size of the firm increases, right, substantially. So this is in literature known as empire building. So Managers are basically building their own empire by using your funds. Okay, and we know that with the greater the size of the firm, the greater the status of managers, right? So status of manager is seen as a function of firm size, the number of awards they win, and the media profile, the media coverage they get, right? So normally you will see, top executives get top executive of larger firms get a lot more media coverage, right? So nowadays you all hear about Elon Musk, right? Who recently acquired Twitter, right? Okay, so so media gives a lot more coverage to managers of firms which are larger. So research evidence show that these superstar CEOs or award-winning CEOs, their compensation increases. So if they manage a larger firm, then they get more compensation. By managing a larger firm, you get higher salaries, bonuses, and remuneration. But although they get these more remuneration, but actually they spend less time managing the firm. Okay, so you can see, so there are managerial motives for merger and acquisitions. So they are not purely seen as investments with positive NPV, but managers have incentives to engage in these transactions for their own benefit, right? Because if they acquire other firms, the size of the firm increases. With larger size of the firm, their compensation increases. They get more media coverage, right? They have access to greater resources. And the research evidence shows that these superstar CEOs do a lot of other activities instead, and spend less time uh, managing managing their own firms. So superstar CEOs, although have positive correlation, their remuneration have positive correlation with firm size, but they spend more time writing books and sitting on outside boards, and their golf handicaps are lower. The golf handicaps is a measure of how good of a golf player you are. The lower your golf handicap, the better player you are, right? And the only way to be a better player if you practice it a lot more, right? So these superstar players spend a lot more time on the golf clubs rather than in the firm. Okay. And at the same time, we see that their firms underperform, right? Okay, so the power of the CEO is also a function of firm size, public profile. So they have enhanced control of the board. Uh, it increases the number of awards that they're likely to get. We know that the remuneration is a function of firm size, and their bonuses tend to increase with successful acquisitions. So you can see managers have incentives to acquire other firms, right? So besides these monetary benefits, there are other psychological benefits as well. So excitement of the merger process. Uh, so when you engage in a merger and acquisition transaction, it generates some sort of excitement and thrill in managers. There is a quote from John Kay. So for the modern manager, only acquisition reproduces the thrill of chase, the buzz that comes from late night meetings in merchant banks, the morning conference call with advisors to plan your strategy. Nothing else puts your picture and pronouncements on the front page. Nothing else offers so easy a way to expand your empire and emphasize your role, right? So you can see managers may engage in merger and acquisitions, even value destroying merger and acquisitions for their own benefit. So most CEOs believe that the markets underprice their firm, and by underpricing their firm, essentially they are saying that market has underpriced, has underestimated their abilities. They think that their firm is better, right? And the market doesn't know. Okay? So, so this is what we call the managerial overconfidence. They are overconfident. They have this hubris. Uh, so what is hubris? It's the overwhelming pride, usually leading to retribution. So in so when someone is extremely overconfident of their own abilities, right, it often results in retribution. So they will end up paying for this, right? So in Greek mythology, I don't know how to pronounce this. Is anyone here from Greece or anyone knows Greek? No. So let's call it Icarus, right? So um, so it is one of the characters in Greek mythology who and the story is that uh, he flew too close to the sun. Uh, I mean, he believed that he could fly and he could fly much closer to the sun without paying any price, and eventually he got killed because he flew too close to the sun. So it's like, you know, believing too much in your own abilities that you can do anything, but in reality there are negative consequences that you may have to face. So this hubris theory is hubris hypothesis was proposed by Richard Roll way back in 1980s. So according to this, acquiring firm managers believe the target is worth more than the market does. And that's one of the main reasons why you pay such huge premiums for the target. So you, as a manager, you believe that the target firm is worth much more, and the market has mispriced it. So, for example, if you manage it, its value will jump up, right? Okay. So, and because you believe that the target firm is underpriced, you pay a premium to that. Okay. And as a result, you end up overpaying. It might be the case that you don't know much better than the market. The market may have correctly priced it. It's just that because I'm overconfident of my abilities, I might think that these are undervalued, but in reality they may not be undervalued, right? Okay, good. So this hubris is associated with overconfidence, over-optimism, narcissism, and illusion of control. So managers are usually impressed with their own abilities, right? In reality, managers are just like us, right? They do not have superior abilities, right? So, you know, after some time, it might be one of you, who might be controlling one of the, let's say, CEO of one of the top 500 firms, right? But you sat on the same benches, right? You sat in the same class with your friends. You may not have, extraordinary abilities. Okay, such CEOs also take credit when things work out and blame others or outside events for their failures. So this is, in literature, we call the self-attribution bias. So what is self-attribution bias? If things go right, you say, look how great I am, right? I did things so well. And if things turn out bad, then you blame others or external forces, right? A really good example of this is, for example, when the Bank of England makes forecasts about future, right? The inflation rate will be this, or growth rate will be this, right? If those turn out to be right, then say, okay, see how good we are, right, in predicting. But if those go wrong, then you blame other factors like, uh, certain things were not as expected. There was an unusual steps taken by the government, and then it's the broader supply chain issues in the world, right? So instead of blaming yourself that we ended up with a wrong forecast, you blame it on other factors. This superstar CEOs do the same thing. So overconfident CEOs overestimate their ability to generate returns and undertake mergers that end up destroying firm value. The market reacts significantly more negatively to takeover bids by overconfident CEOs. So again, you can see the market is actually smart, right? Market knows if an overconfident CEO is acquiring another firm, then the market reacts negatively to it, assuming that it might, reflecting that market believes that it might end up destroying firm value. That's why it reacts negatively. So overall, and we also see that overconfident CEOs are the ones who make more acquisitions. Okay. So we have, okay, besides the managerial motives for empire building, control, right? There are other parties who benefit from merger and acquisition transactions. So here we have advisors. So the role of advisors in merger and acquisition. Okay. Hello. Role of advisors, right? Something you mentioned earlier. So when you do enter into a merger and acquisition transaction, you have to do the due diligence process, right? But there are agency costs here, right? Investment banks' earnings are usually around 3 to 4% of the amount, 3 to 4% of the deal value. So for example, you're doing a deal of like 100 billion, 3% of that would be $3 billion, right? That you earn 3 billion in just one transaction. Okay? So they have an incentive to make sure that these transactions go through. Even they will earn 3 million, it doesn't matter whether the value is attached value or destroyed value. So there are agency problems. Croft paid its advisors approximately 400 million on its 11.6 billion acquisition of Cadbury. So they paid 400 million to advisors, right? Prudential spent 380 million on its failed bid to acquire AIG, Asian Business, in 2010. RBS Consortium's transaction cost in acquiring ABN AMRO in 2000 were estimated at 660 million euros, right? So you can see these advisors charge huge fees, and most of these fees are conditional on deal completion. So you can see deal making is a profitable business for these investment banks. So according to Warren Buffett, so it's a honeypot for investment bankers and other professionals on both sides, right? So the acquirer firm will hire an investor bank and target firm will hire an investment bank. They do the due diligence process, right? But they have an incentive to earn these huge fees, right? So they would want them to do the transaction, okay? So top merger and acquisition bankers are known as rainmakers and paid accordingly, right? Rainmakers because if they do one transaction and they make millions for the bank, investment bank in one transaction. So in summary, we can see many management. So this is kind of summary. It nicely summarizes what we have covered so far. So again, this is a quote from Warren Buffett. So what he says, so all of you, I think you must have heard about this, story of a prince or princess who kisses a frog or toad, and then they become either a prince or princess, right? And then they marry and they happily out, right? So many management apparently were overexposed in impressionable childhood years to the story in which the imprisoned handsome prince, so management there is a prince, right? Okay, imprisoned handsome prince is released from a toad's body by a kiss from a beautiful princess. Consequently, they are certain the managerial kiss will do wonders for the profitability of the company. Their target company, right? So if they manage target company, they do wonders and increase the value tremendously, right? So we have observed many cases, lots of merger and acquisition transactions, but very few miracles. So very few, turned out to be princes. Okay, nonetheless, many managerial princesses remain sincerely confident about the future potency of their cases, even after their corporate backyards are knee deep in unresponsive thoughts. So these managers still believe that they can do wonders, that they still keep kissing the courts, right? And although they're knee deep in the courts, they're surrounded by all these bad merger and acquisition transactions, but they still continue to kiss more frauds, continue to engage in more merger and acquisition transactions, in the hopes that one of them will turn out to be a prince or a good one. Okay, good. So that's kind of everything that you need to know in terms of merger and acquisitions. Lastly, I'll quickly go through uh, some of the uh, beneficiaries of merger and acquisitions. So we have seen that acquirers, on average, do not benefit, right? Okay. What about society? Does society benefit? Society, on average, is neutral to merger. So the research evidence suggests that at best mergers are neutral in economic terms. So they neither add value nor destroy value. Okay, and any economies of scale that you get from a merger are offset by larger market growth. So even if you get higher economies of scale, which means you're reducing your cost, but as a result of that, you also gain more market share. You have greater control of the market. So you may not necessarily pass on that cost saving to your customers. Acquirers, we have seen, on average, they do not benefit, right? Acquirers do not benefit. Target shareholders definitely benefit. Why? Because they're paid a premium, right? So target shareholders definitely benefit, overwhelmingly benefit from merger and acquisitions, whereas acquirer firms, the conclusion about acquirer firms is uncertain. Most of these firms lose, right? Greater proportion of these firms lose, but in some cases they gain as well. From employees' perspective, we see that employees typically lose their jobs after the merger and acquisition. And that's, are you calling this takeover of WhatsApp? WhatsApp is acquired by, sorry, Meta Group? Twitter. Yes, Twitter. Sorry, I said WhatsApp. No, Twitter. What about Twitter? Right? Twitter is acquired by Elon Musk, right? So what's happening with that? 75% of IT team left, right? Lots of firing, right? And he's firing people on I don't know, like SMSs, right? So lots of jobs, lots of employees lose their job post merger. What about directors of acquirers? Increased remuneration. We know acquirer, as if you're an acquirer, we know if they acquire the other firm, the size of the firm increases, and with size, the remuneration increases, their status increases, their power increases, right? So if you are a manager of an acquiring firm, it's like a one-way ticket for you, right? If things turn out good, that's great, right? You will benefit from the gains as well. But if things go bad, you won't lose anything. You will still benefit, right? You will end up owning a larger firm anyway. So it's a one-way bet. CEOs' pay and wealth are completely insensitive to poor post-acquisition performance. If after acquisition, if the firm does not do good, managers' wealth and remuneration is insensitive, right? But they do see an increase in their wealth if the post-acquisition performance is good. So also, if so, directors of the acquiree, the target firm, right? So directors or managers in the target firm, they can also potentially benefit. So the question is, do they sacrifice bid premiums to their outside shareholders in return for a golden handshake? So if you are a manager or a director in a target firm, right, you can potentially accept a lower bid if you get compensation somehow, right? So in exchange for compensation, your personal compensation, you can potentially accept a lower bid, right? If you accept a lower price, who bears the cost? All shareholders of the target firm. But you as a director would benefit because you're getting some remuneration or some compensation. So evidence of acquisition, so there is some evidence of acquisition induced compensation of target firm CEOs. So acquirers overtly pay certain CEOs to sacrifice managerial control, or equivalently, that some CEOs purchase executive jobs in the buyer firm by foregoing cash payments they might otherwise have obtained, right? So if you are a manager in the target firm, what you can do? You can either get bonuses or cash payment to accept a lower offer, right? Or you can get compensation by getting a job in the new firm, right? Okay. So there is some evidence of an inverse relationship between bid premiums and unusual bonuses to target CEOs to step aside. So if target firm CEOs get unusual bonuses, those firms typically get lower premiums. So directors of the target firms or CEOs of the target firms also benefit from merger and acquisitions. So in JP Morgan's 58 billion acquisition of one bank, a lawsuit charged JP Morgan could have paid $7 billion less in exchange for Jamie Dimon of Bank One being appointed president and CEO of the combined group immediately. So in a lawsuit, when JP Morgan acquired Bank One, so the lawsuit established that the company could have paid $7 billion less had they had retained the target firm CEO, or the target firm CEO being made the CEO and president of the new firm, combined firm, right? So you can pay less, but so the argument basically is, I might accept a lower offer if I get your job, right? So the target firm CEO will say, okay, we can agree on a lower price if I manage the new firm, right? So advisors, we have seen, benefit in a lot of ways. There are agency conflicts, as fees usually are only payable on deal completion, right? So although they are responsible for due diligence, right, but they have an incentive to complete the deal because they will get their commissions and fees once the deal is completed. So even though if the deal or merger is a bad one, they have an incentive to go with it because they will get their fees as a result. So most of the mergers fail because the strategy is misplaced, right? Merger conducted for managerial reasons and not for value creation, and there are post acquisition failures in the process of integration, right? Or the failure could be the result of a combination of all these three factors. So we have seen mergers could fail because of inappropriate strategy, inappropriate reason for the merger and acquisition, right? And also because the merger and acquisition is not executed in a way that would add value. Right, so in summary, major firm strategic decisions. So these are major firm strategic decisions that we have seen lose money on average from an acquirer's perspective. Target shareholders, we know, benefit because they are paid a premium, and in some cases they are paid premium up to 50%, right, which is substantial amount, right? There is little evidence that conventional rational arguments always fit. So merger and acquisition deals are a behavioral playground, right? Most of the merger and acquisition transactions are done for behavioral reasons, for CEO's power, for CEO's influence, because CEOs are overconfident, right? They overestimate their abilities. And as a result, we see on average that cash deals perform better, right? Because when you're paying hard cash, then the process is the due diligence process is much clearer because you are paying a certain price, fixed price for the target. Target shareholders, advisors, and the directors of both parties, both the acquirer as well as the acquiree firm, typically benefit from the merger and acquisition transactions. So we have seen there are very good reasons why merger and acquisition transactions fail, and a lot of them do fail. Good. So that's pretty much it for today, and enjoy the rest of your day.